Okay. On behalf of the Women's Business Development Center, welcome to everybody for our second The Show Goes On succession planning series. Today, we're going to be focused on ESOPs, employee stock ownership plans. It's a thing that a lot of, or it's a tool that a lot of our WBEs and other business owners are looking at increasingly as a succession planning option. So we're glad that you are making the time to be with us today. I am going to turn this over to Ashley Thronson, who is at Frederickson in the Twin Cities. She's going to be our facilitator or our moderator today. And Ashley, please take it away with our panel.
Thank you, Karen, and thank you all for being here today. As Karen noted, we are diving into the world of ESOPs today, and I have with me an amazing group of experts in this area who are happy to answer all your questions. We have some prepared content, and we'll be having a dynamic conversation as to kind of the high-level things that we want to discuss. But certainly, if you guys have questions, you can send them in the chat, or at the end, we'll have time for questions as well. So without further ado, I would love for our wonderful panelists to introduce themselves because they know themselves best and how great, how much they know about ESOPs and how they will interact with this panel. So Deb, why don't you go first?
Sure. Happy to. Thank you, Ashley. Deborah Linder with Frederickson and Byron. I'm the chair of our compensation planning and employee benefits group. I've been with the firm for about 35 years now and have worked with ESOPs and kind of all things benefits over that time, but work with a number of ESOP companies, work with trustees on transactions, work with companies on transactions. And so kind of, all of the aspects of the ESOP world. So with that, Caitlin.
Hi, Caitlin Skopek. I am a director in corporate advisory with BMO, and I was on the first panel, and I will say it again. My job is the greatest job in the world. I get to just help business owners figure out what's next. To Karen's earlier point, a lot of business owners are pursuing and learning more about and actually transacting in the ESOP space. So I help our clients learn about ESOPs, evaluate if that's the right option for them, what other options are on the table, go through that process. And then I bring in much more technical experts like the folks on the call here during the transactions. But we also are a big part of ESOP transactions as we finance the transactions. As a bank who lends to the ESOP community, we're one of the largest ESOP lenders in the country. So we spend a lot of time in the space and know the good, bad, and the ugly of lending to transactions in the ESOP space. So that's my role in the ESOP world, and I'll pass it over to Dylan.
Great. Thank you, Caitlin. My name is Dylan Luchuk. I'm a vice president and partner with Paroline Capital Partners. Paroline Capital is a middle market merchant bank. So what that means is think about a traditional investment bank. We offer holistic ownership transition solutions to business owners, much like yourself, who are seeking kind of that next phase of ownership. Our national calling card is ESOPs. I probably spend 75% of my time focused on either implementing new ESOPs or looking at long-term ownership alternatives for ESOP-owned companies. So for a lot of companies, an ESOP is a great alternative, and sometimes it's a great alternative forever, and sometimes it's a great alternative for 10 years. And so we assist companies both going in and coming out. And then we also invest in ESOP-owned companies as well. So we have a fund that we utilize to invest alongside of our clients, helping promote and support employee ownership across the U.S.
Perfect. Thank you. And thank you all for being here. We really appreciate it, especially given that it's right in the middle of a big ESOP conference that all three of you were at. So we really appreciate you taking your time and sharing your wealth of experience with all of us. So to start things off, I think it would be helpful because not everyone might know exactly what an ESOP is. So let's frame up the conversation and talk a little bit about what exactly an ESOP is, so we're all working from that same knowledge base. Deb, did you want to kick us off on that one?
Sure, I can do that. Simply put, an ESOP is a type of retirement plan. It's a type of a defined contribution plan, much like your profit sharing 401k. The difference is that it is designed to invest in company stock. So instead of having an account that's invested in mutual funds, the employees will have an account that's invested in stock of the company. And then their retirement benefits grow as the value of the stock appreciates, hopefully it goes up. And that's what creates the retirement income for the benefit for the employees. Like any qualified plan, any kind of retirement plan, there are a whole host of requirements that apply under the Internal Revenue Code and the Department of Labor rules. And then there are, many of the rules are the same as they would be for a profit sharing plan, but then there are some special rules that apply just to ESOPs with regard to things like when do participants have the right to vote their accounts, when do they have the right to diversify their accounts out of stock and into something else, if they have the right to demand stock as part of their distribution. There are some special rules around that. So maybe I'll stop there and let Caitlin and Dylan chime in.
Deborah, you nailed it from my perspective. One thing I like to say, and this is because ESOPs are complex, and so as you start to dive in, we do a lot of ESOP 101 and then 102 and 103, so it's a learning process. And even those of us who serve ESOPs, we go to these conferences to continually learn because there's so many ways to skin the cat per se. But I think you kind of described how I very high level think about it. It's kind of like a 401k plan that owns your business, right?
Right.
And so it's a really great tool. We're going to get into the details of kind of how it can work and some of the nuances. And I think we have a small enough audience that we can answer questions today, as you guys might have questions either throughout or at the end. But that's how I describe it in a very 101 sense. And I think you nailed it.
Good.
Yeah, maybe just to add one thing there, Deb, as we think about it and we describe it to our clients, the one important nuance or two important nuances as we think about kind of broad-based employee ownership is one, employees don't have to contribute anything to this plan.
Right.
What we frequently see from, even companies with great 401k match programs is just a lack of involvement from employees. Frankly, a lot of folks live paycheck to paycheck and they don't have the ability or perhaps haven't received, the proper education, understand the benefits of employee matches, but there's just not that level of engagement. And so what's great about an ESOP is, as Deb mentioned, there's a lot of asterisks and everything we'll talk about today, but generally everyone in the company is going to be participating and everyone receives that benefit for showing up, for kind of that sweat equity, if you will.
Yeah,
and
it is essentially a gift from the employer, if you think of it that way. Yeah.
Exactly. And then the second benefit as well is that this is something they can influence. So while, if I'm going to invest in the S&P 500 through my 401k account, I can't impact the performance of Google, right? But I can impact the performance of my company. And so it becomes this really powerful tool where folks can begin to see, hey, if I do X, that results in a higher stock price directly benefits me. And so that's one, and as Deb mentioned, that's the whole point of the ESOP and is invested as sponsor plan securities. But that's really one of the benefits we think about talking to individuals as to, why an ESOP could be an interesting alternative.
Very good.
Yeah, wonderful. And this was touched on a little bit, but just to make it explicit for people like me who maybe don't know, all the ins and outs of ESOP. So an ESOP really is the employees are the owners, right? Everyone who's involved in ESOP is an owner, right? Okay, so why don't we talk a little bit about, if a business is considering an ESOP, what are those considerations that might make them a good candidate for going down that path? Caitlin, did you want to start off with that one?
Sure. So we talk about it in a couple buckets of categories. The first being the selling shareholder or the owner, and what their priorities are and how the business works and all sorts of things around what they are trying to achieve in an exit strategy. But really recognizing that an ESOP is a slower exit. So an owner who may say, I need money today, I want to be out of this business and I don't want anything to do with this business. First and foremost, ESOP's usually not that path. So we really do a lot of diligence with an owner to have a conversation of, what are you trying to achieve? What do you want for your business? What do you want for yourself and your liquidity? Your estate planning and taxes. So first and foremost, what does the owner need? Second is, what is the business underneath the ownership. And so that is, what is the management team? If you're no longer in the business, who's going to be running the business?
Mhm.
What is the business cash flows and situation in what industry? How stable is the business? So then you start to really understand that category and if that makes it a fit. Typically, we look for a certain size threshold as well, for if you're going to finance an ESOP transaction versus if it's going to be seller finance. So we'll talk a little bit about financing, but that also requires a certain amount of cash flow for the business. So that's really the second is the management team. And then the third is, what is that business? And then the last high level category, I'm staying at the 30,000 foot level here. So Deb and Dylan can kind of come further down, that we talk about is the employee base. And really that is also a very crucial factor in deciding if a company is a good candidate for an ESOP. What does that employee base look like? How long tenured are these employees? If there's a business where you have constant turnover in employees, that's usually not an ESOP candidate. How many employees are in the business? So a lot of those questions come into place. And in further detail, if anybody wants to talk through, we usually have like a checklist conversation of, does this really make for a good candidate in those ESOP 101, 102 conversations? But those are the four big categories that we kind of focus on. Deb, maybe I'll let you elaborate on some of those categories.
Yeah, no, I agree with all of that. I think it's very important to have, as I put it, a strong and stable payroll base, a meaningful number of employees. I have had ESOP clients with as few as 10 or 12 employees, which it can raise some challenges. We usually think, somewhere around the 40, 50 mark is maybe kind of the minimum number of employees that an ESOP candidate might have. The other thing that I would mention too is that the company has to be either a C corporation or an S corporation. A number of companies now are formed as LLCs. It can be a little challenging, if not impossible, to have an LLC sponsor an ESOP. So typically it's going to be a C corporation or an S corporation that the company would have to be in order to have an ESOP. But otherwise, I agree. You typically see the owner kind of nearing retirement age, wanting to exit in some fashion. And I would also say that the owner needs to embrace the notion that employees are now going to be quote unquote owners of the business and are going to be interested in how the business is doing, financially and otherwise. So
A quick piggyback on that, Deb, about number of employees. So is it generally the more employees, the better, or not necessarily? Is there a sweet spot in there?
I say that we need a meaningful number of employees because of some very complicated testing that comes into play with an ESOP, especially if the ESOP is maintained by an S corporation. The IRS rules make it a bit difficult for a small company to have, as an S corporation, a small company to continue to be an ESOP. So it really is a function of making sure that you have sort of critical mass, to make that work. Yeah.
Great.
And as we think about that, to piggyback off that point and maybe add a few more, but a big part of ESOPs that all the advisors and everyone who's speaking today thinks about is sustainability. Mm-hmm. So the idea with an ESOP, which is great, is that it gives a benefit to your employees. Now, when you think about what that benefit means and where it comes from, it means the company itself is going to be making payments to employees upon termination at the highest level. There's a few, again, asterisks on that, but it's generally upon termination or retirement. Mm-hmm. And so as you think about that, let's say you did have 10 employees, then all your employees owned an equitable amount of stock. And I'm ignoring some of the compliance items that I mentioned, which is also critically important. But if someone were to leave, you'd have to buy back 10% of your stock, which is a huge burden on the company.
That's a huge burden. Yeah.
Yeah. Whereas if you have, let's say, 100 employees, you're buying back 1% of your stock, which is obviously much more manageable. And so that's the highest level, one way to think about sustainability, and something that we do as part of our kind of work of implementing ESOP is making sure this makes sense. Now it sounds like a meaningful outflow of cash and capital for the business, but one of the best benefits of an ESOP, which we haven't touched on yet, is if you are a 100% ESOP owned company and an S corporation, you no longer pay taxes. So what happens is the tax obligation under an S corporation goes up to the shareholder. Your shareholder is the 100% shareholder is a tax exempt entity. And so with a very few small exemptions, primarily for local taxes or industry specific taxes, you don't pay state or federal income taxes anymore. And so as part of that, what we most frequently see is that the benefits from no longer being a taxpayer are going to be more than offset what we call that repurchase obligation, which is the amount of money you owe to departing shareholders. And so to go back to the question, one thing that is very important as we think about who makes a good ESOP is who can take advantage of those tax savings. We've had incredible companies looking to explore ESOP ownership, but that had very large fixed asset bases, that have large depreciation expenses, which means that they generally pay little to no income taxes to begin with. As part of implementing that company, they're transitioning that company to an ESOP, they aren't receiving that benefit, and it's just an incremental expense. Whereas on the other side, we have a client out in Sioux Falls, about $200 million in revenue, and their primary asset is inventory. They have about $80 million of inventory. That inventory doesn't depreciate, and so they pay a lot of taxes. And so for them, the ESOP structure is very cash flow positive. And so that's something that you'd want to consider as well, is can you take advantage of tax savings about whether an ESOP might make sense for you.
Excellent. Yeah, those are great considerations. And along that line of thinking, what are some other benefits or positives of an ESOP? And then we'll cover the cons in a few minutes. But if Caitlin or Deb, if you have other pros of doing an ESOP, I'd love to hear your insights on those.
Yeah, Caitlin, do you want to go ahead and kick it off?
Sure, I'd be happy to. All I have to say is if you want to hear the pros, come to an ESOP conference and meet everybody, because first and foremost, it is an incredible tool to spread equity to your employee base, right? There is nothing out there like it. And that has there's so much research beyond, and we could share some, but on how great that is for your employees and for your community and for yourself, right? You're getting liquidity out of it too if you're a business owner. So there's a lot of positives there. It's a slower exit too, which, in many forms, I say this because a lot of business owners, especially women, as they start to evaluate and put a plan in place for selling and transitioning their business, they're not 100% sure they want to go down one path or another, right? There might be kids in the business, what they're trying to evaluate. An ESOP's a little bit of a slower transition, and you can take some time in really setting it up and evaluating it and seeing if it's the right option for you. It's not like you got an offer and you're being pushed into, I need to sell to private equity tomorrow, and you have no control over what happens to your employees and your legacy that you've built. And so there's some positives for a seller to consider. You get to control the destiny of the transaction. When you're selling to a third party, that's not always the case. You don't always get to control what happens in the future. So there's a control element. I won't say you control the company if you sell 100% to the ESOP. There's, a new structure in place. I also will caveat that, because that's a big fear we hear all the time is, well, I don't want my employees to own this company tomorrow, right? Like I like my management team, but I don't, want them running the show tomorrow. And we caveat with, that's not how it works. There's a vesting schedule, and we can talk through kind of how it happens over time. So I would say the timing and the control are two really big positives, aside from the biggest positive, which is your employee base and sharing the equity there. There's so many success stories out there. If you start to research ESOPs, you're going to see all of the success stories and the culture. I call it a little bit of a kumbaya culture, but it's there for a reason, right? So many people are invested in this for a reason. So those are kind of the higher level cultural components that I think of as positives.
Yeah, and I would agree. There's a fair amount of evidence that, being an ESOP company can really improve employees' motivation, their productivity. If you embrace the employee ownership culture and share the good news and the bad news and how the company is doing financially and getting folks in, thinking as an owner, that can really help with the productivity and the success of the organization. One advantage that I'll mention that's specifically for C corporations, at least at the moment, for C corporations, for the selling shareholder, if you're a C corporation and you sell at least 30% of the company to the ESOP, there's an ability to take the selling proceeds that you receive and reinvest them in a particular way and defer the tax on the gain on that sale. So there is some tax advantage for the selling shareholders if it's structured properly. There are a whole lot of details and nuances to that, but it's something to think about if you happen to be a C corporation. And I have seen transactions where the company will either, if it's an S corporation, they'll revoke their S election to become a C corporation so that the selling shareholder can take advantage of that tax deferral. And then when it's appropriate, switch back to an S. But there are ways to structure that. I'm sure Dylan has worked on transactions like that as well. But I also have a transaction that I'm working on right now where it is a C corporation. And so they're going to do at least more than 30% so that the folks can do the rollover treatment. It's called 1042 rollover. And then after that, they'll elect S corporation status. So they get the tax advantages that Dylan was mentioning. So there are lots of different ways to structure that can be a benefit for both the employees and for the company and for the selling shareholder.
Yeah. From my side, and Deborah, you mentioned a little bit with selling, above 30%. One of the best part of an ESOP in my mind, on top of the cultural items, on top of the tax savings, is the flexibility. So what's great about an ESOP is if you think about selling to private equity or a strategic party, most time they're going to own 100% of your company, and it's going to come with a lot of stipulations, and they're going to say, this is how we do transactions. We're going to invest in a preferred instrument. You're going to be in common if you have rollover, or this is how it's going to be structured. We're planning on closing your facility within this many years. We expect you to transition within 3 years, and we're going to put our own person in. What's great about an ESOP is you get to structure it. There's a negotiated transaction with a trustee as part of that. So again, it's a few more asterisks. But generally speaking, you get to structure this how you want. And if you want to sell 27% of your company to an ESOP, you can do that. We frequently see this where you have disparate shareholders who have different objectives. Maybe you have maybe you're a 70% shareholder and your child's a 30% shareholder and still in the business, and you're interested in getting liquidity for your portion, but you want them to retain the equity. You can structure it in such a way that 70% just your share are sold to the ESOP. And let's say, for example, it's critically important that your name remains on the door, right? And you want to ensure that your family has governance rights or a part of the board for the foreseeable future. There's ways in which you construct that or construct that. So there's a contractual requirement for that to continue to happen. And all these things will impact value, it'll impact the structure, it'll impact how the ESOP thinks about the deal. But it does provide you a lot of flexibility to achieve your objectives. As Caitlin mentioned, the one thing an ESOP can't do is pay you 100% cash for your shares. There's just not going to be capital.
Yeah. It doesn't work.
Yeah, exactly. But if you're willing to say, hey, I'm okay being paid out, over 5 to 7 years, and these are the points that are most important to me, and ESOP is a great solution.
Yeah, it sounds like an amazing option. So what are some of the potential downfalls or negative things to consider with an ESOP?
Yeah,
go ahead, Dylan. Yeah, why don't you go ahead? Yeah,
I was going to say, just to maybe continue the thought I had there, the biggest downside we most typically see is liquidity. So for a lot of shareholders, it's an odd concept to say, I'm selling my company, let's say I'm selling to 100% ESOP, but I'm only getting 30% or 20% in cash. But effectively, you can think about it as you're financing the deal, right? So your employees are it's kind of like they're buying something with no money down, is a good way to think about it. where you're going to help them finance that and the company's going to pay you back over time. For certain shareholders, that's great. If you've been thinking about retirement for the last 10 years, you have 5 more years in you, this an ESOP can make a lot of sense. If you recently had a health scare or, for whatever reason, your focus in life has changed and you say, hey, this is my last year, an ESOP is going to be much more challenging. The other parts of an ESOP that I'll say are downsides or considerations are that it does require that ongoing repurchase obligation to your employees. Part of that's a great thing, right? It's how you give them benefit. With that being said, it's something that has to be carefully managed. We do find ESOPs frequently sometimes suffer from success, where you might have an ESOP and they double or triple in size, and suddenly they look around one day and say, wow, I wasn't planning for that repurchase obligation, and holy cow, now, a lot of my folks have $250,000 in their account, right? And folks are leaving and I have to pay that back, and yeah, these other investments I have to make, and how do I balance all of that? And so those are all things, again, it's kind of a double-edged sword, because that's why you do an ESOP is hopefully to make those. It's a great outcome, but it's also something that needs to be managed.
Yep.
Dylan,
Yeah,
I
the
might.
cash. Go ahead. Yeah.
Sorry, I was just going to add to that exact thought really quickly. Is the next big piece of consideration that I would add to that is the ongoing kind of operating costs of an ESOP.
Right.
To Dylan's point, there's a lot that has to be done both in setting up an ESOP, but then in long-term management of the sustainability of the ESOP. And so there's great tools and great advisors out there. There's things like sustainability analysis, and there's things that you can do to manage that. But all of it does come at a cost to the company. And so that's where size of company also comes into play. And I know, in our previous audience, we had a huge range of size of audience. So that's why I'm kind of staying broad. But it does matter in the ongoing costs as you consider the ESOP. Now, to Dylan's other point, there's savings in the tax structures. There's usually ways to capture some of the cash flow of the business to offset those costs, and along with offset the repurchase obligations, but making sure that you have really good sustainability planning and insight into the futures. That's why we tend to see ESOPs in much more stable cash flow industries versus industries that have very lumpy, big swings in business. So it's something to be considerate of.
Yeah.
Sorry, Deb, didn't mean to jump.
No, that's exactly what I was thinking. The cash flow needs for the ESOP are something that you really have to manage. And the sooner you start, the better. I have some mature ESOPs that are struggling a bit, because they didn't, plan for that ultimate day when everybody's account balances grew significantly. And then I have other ESOPs that are in the early stages, but being very thoughtful about getting cash into the ESOP and as much as they can, as soon as they can, so they can manage those obligations down the road. The other thing that I would just mention in terms of a perceived negative anyway, is that ESOPs are heavily regulated by the IRS and by the Department of Labor. So like we mentioned before, there are numerous requirements that you have to meet, both on the Internal Revenue side and the Department of Labor side. But that risk of an audit that is always out there, and that can sometimes be viewed as a negative as well in the ESOP world. So and in terms of the cost, one of the things that you'll have that you may not have with like a 401k plan is that you do have to have an annual appraisal of the stock each year. And that will come, there are some additional administrative expenses with an ESOP that you wouldn't necessarily have with other retirement plans.
Yeah, great point. One other thing I would just put into the equation here as you're thinking about an ESOP, obviously in those first few years, to Dylan's point, the cash flows of the business are going to repaying the selling shareholder. Now, we come across this quite often where we have a fast growing business and maybe the selling shareholder is a little bit younger and has a longer runway and says, hey, I want that capital to be in growth mode, right? I have so many opportunities. We're growing this business so fast. You have to be really cognizant that in those first 5 to 7 years, the cash flow is being directed towards the selling shareholder. And then in the future, in the mature years, a lot of that cash flow is going to be directed into the employees who are exiting the business. So making sure you have a really good strategic plan for the business and really understands that future cash flow, how much of it is going to kind of go where, and then what's left over to make sure that that business is, running smoothly and growing at the needs that it has, and making sure the capital is all there. That's part of the planning process. That's part of what good advisors are helping you with. That's part of what banks who provide the capital for these transactions should be providing you with. But it's stuff that you have to address if you are going down that path.
Yep.
Excellent. And you all touched on this, but piggybacking on that, Caitlin, so who, I guess, is on your team, so to speak, if you're thinking about doing an ESOP, who are the people, so to speak, jobs or, entities that you're going to want to talk to get on your team to make sure that you're thinking through all of these things?
It's a really good question. In the last session, when we were talking about either internal or external sales last week as a broad group, one of the points that was brought up is there's a lot of free advice out there, and you don't have to go hire somebody to get you all the way through a transaction before you're ready. So being very cognizant of that, as you are 3 to 5 years out in your transition planning, like we talked about, start getting some free advice. So there are a lot of advisors that'll help you with ESOP education. There's a lot, and that can be your accounting firm that has expertise in ESOP. That can be your lawyers, your bank, your advisors here like Dylan who transact on ESOPs. So we call that assessment, and really making sure you're talking to a handful of folks in that assessment. Is this the right option for me as I'm starting a plan? Once you start to identify maybe this is the right option, going into a little bit more of feasibility work. And so that's where some advisors will do that for free or a low cost, but it's really important to do some feasibility work and see if this actually would work for your business. I highly recommend, and this doesn't always happen, including all of your other advisors in that process, because very often what happens is you get some feasibility work done, and then your bank or your CPA or somebody else or your lawyers or your tax, they poke a hole in it, right? And so the more you can do all together in that stage, the better. And then going into the structure, you really should have an advisor, whether it be your lawyer or someone like Dylan, an investment bank, et cetera, helping you kind of structure that. Advisor is going to hold your hand and walk you through that whole process and then through execution. That's their world. I just really emphasize, like, as you start to do the evaluation, making sure you take advantage of that free advice, those folks who want to help you think through it, and then really hiring the right team and evaluating the right team as you get closer to feasibility and execution.
Yeah. And going forward, you'll have, you may have to consider having an external, what we call an external trustee, somebody that is not within the organization. There are various folks that can serve in that role. Financial institutions, there are some individuals that will serve in that role as well. That trustee will hire the valuation company that will value the stock each year. You'll typically have a third-party administrator that will help you with the administration of the plan, much like you would with the 401k. You'll have your benefits counsel. You'll have, folks helping you with the sustainability, feasibility, and, that managing that cash flow obligation. So there can be a variety of folks on your team, so to speak, both at the beginning and then throughout the life of the ESOP. Yeah.
Perfect. So you don't have to do it alone if you
That's exactly right.
Decision.
That's exactly right. Yeah.
And actually, maybe just add one more kind of angle to that. We'd also encourage you to, bring to the table your management team, right? Your management team and personal wealth advisor, your family. It's not uncommon, honestly. We take calls with, the owner and their significant other. And this is one of the most critically important things that you're going to do in your life is thinking about transitioning your business. It's not uncommon that we're working with folks who, it wasn't them who started the business, but their parents or their grandparents. And this is really going to impact the communities they operate in, their family, their retirement plans, and the management team and the trusted folks in your company that's helped make it so successful. And so while there's obviously always considerations and some confidentiality concerns, and you don't want to, open the kind of Pandora's box too quickly, some of the most successful ESOPs we've worked with are a little bit more open and transparent, at least within that inner circle. And especially with management, as you think about it, they're the ones who are going to have to kind of live with this, right? Where you're transitioning the business. And I suspect the reason you joined this call is because you want to do it for the right reasons and reward those around you who've helped make you successful. And so to ensure that they're on board with this structure is, very helpful, and ensuring that, the company isn't, only ESOP owned for the next 10 years, but ESOP owned for the next 20 or 30 or 40 as we think about that next generation of leadership.
Yeah, all
Good point.
really, really good point. So one thing that we touched on, but I want to make sure we cover it explicitly. I think all of you referenced that it's possible to do 100% ESOP where your employees own everything, but it's also possible to do a different percentage. And so maybe you guys can talk a little bit about what you see as most common, or if there is a most common, or maybe kind of pros and cons of what that right percentage is for each business. Deb, do you want to kick off that?
Sure. Well, and I would say it's kind of all over the map, right? I mean, many times if the selling shareholder is interested in that tax deferral that I mentioned, we'll see 30% or more. Sometimes I've done transactions that are at 40, 50%. It's not unusual to have folks go from 0 to 100, depending on how you can structure it. And then I have some clients that want to do more of a staging approach, where they'll sell maybe 30% and then another 20 or 30% down the road, and then ultimately get to 100%, but they'll take some time to do it. Mostly because they don't want to strap the company with all the debt right away, to go from 0 to 100. The other thing that I would mention for women-owned businesses is that sometimes you can't do 100%. If you have to have a majority ownership of a woman-owned business, and I have a client that can't go to more than 49% because they have to have 51% of the company owned by a woman for that certification, you may find yourself restricted in that regard. But it is. I don't know that there's, in my world, that there's a common approach. It's kind of all over the map. But I will say that folks generally are trying to get to 100% so they can take advantage of those tax advantages that Dylan mentioned.
Got it.
Yeah, I would say under 30%, it just becomes logistically and administratively a little challenging for the benefit that you're receiving.
And a little cost prohibitive. Yeah.
Yes, exactly. Where if you just say, hey, I want my employees to own 10% of the company, what I would say is do something more like a profit sharing plan, or something that's a little easier to administer. And Deborah, you nailed it. There, those tax savings, you only, at the highest level, again, there's some nuances here, but generally speaking, you think about the tax savings as you're going to save whatever percentage of taxes that the ESOP owns of your company. And so if the ESOP owns, and there's some other items you get to deduct, some of the expenses we're talking about, but the ESOP owns 30% of your company, you're going to save 30% on your taxes. And so as you think about what might be interesting, again, 30% is usually what we see on the lower end. And then that transition, again, frequently we see the multi-step processes. Frequently we see folks go from 0 to 100. It is really, it's a bit all over the place based on what your individual objectives are.
Yep, exactly.
Got it. Caitlin, anything else you wanted to add, or?
They nailed it. We see it across the board. I mean, I've got clients that are sub 20%, and we talk about, why, and there's reasons why. And I have clients who are on the 100%. We see a lot of, probably about 120 new ESOP formations a year. And it also it changes based on how the markets are and how capital is in the. So there's so many factors. Control is probably the biggest one, you know, and that's beyond tax, I guess, is the biggest one, but control is the second biggest one. And really what you're trying to accomplish with the business, and your back to your strategic plan. What's that strategic plan? And do you have other things that you need to do with the business in the next coming years? So that's another one that we see often. But tax is the biggest driver of most often the decision.
Got it. Yeah, so let's turn towards sort of the financing and tax piece of things. Dylan, do you want to talk a little bit about kind of what the options are for financing an ESOP and what those considerations might be going into that decision, if you've decided that's where we want to go?
Absolutely. So again, gift and a curse of an ESOP is that there's no external capital. It's a gift because that means you're, in a lot of ways, you're controlling your own destiny. When I say no external capital, I should clarify. I mean, the ESOP itself isn't bringing capital. Now, the curse of that is that it reduces liquidity at close. Now, what's great is there's phenomenal lending institutions who specialize on ESOPs, like Caitlin and the BMO team, who this is really what they do, and they can help provide you some of that liquidity. So what we frequently see is when you think about transitioning into an ESOP, is you're going to take a portion of your proceeds in cash based on what you have on the balance sheet and what external lenders you'd like to bring into the transaction. The rest of your proceeds are put on what are called seller notes. So seller notes is your financing of the transaction. So let's just use a really simple example, $100 million transaction. You get $20 million in bank financing. That means $80 million is going to be put on seller notes. What happens is those seller notes are going to charge an interest expense that the company is going to pay every year. Again, as part of the structuring, how we generally think about it is those tax savings should more than pay for the interest. Each year when the company generates cash, it'll both pay the interest as well as make any payments on third-party debt, but also make principal payments. And so that $80 million each year declines as the company pays you for those proceeds that you're due. For a lot of business owners, what we see is that, frankly, they're more than happy to take back those seller notes because the business is what's made them very successful. You know, they didn't grow this business to take all the money out to go invest in the S&P, right? They'd rather actually stay invested in their business, continue to generate that nice return on those instruments as they assist the company and the employees in taking over that ownership over time. One other thing I'll mention that's particularly interesting about ESOP transactions and unique to them, or I'll say they're most well known for, is something called warrants. So a warrant is the idea that as part of minimizing the interest expense on the company or managing the interest expense and put on the company as payment of those seller notes, is that instead of paying you interest, the company will say, we're going to give you a percentage of fully diluted equity that you get to carry on to into the future. So let's say that's in a 100% transaction, you might be looking between 20 and 30%. And so that's another reason while many current business owners and the former shareholders of the company will say, yeah, I'm more than happy to put, seller note financing into this transaction because I get 20 to 30% of the future upside of this company that no longer pays taxes if it's 100% ESOP. And so those warrants can generate really attractive returns that, we typically see to, between, 13 and probably 18% kind of annual returns, which can be really interesting for these business owners. And so generally, there's the seller note financing, there's a bank financing plus seller note. Some business owners also just say, hey, I really don't like debt. I've never taken on debt in my life. I don't plan on that changing. And those do all seller note finance transactions. So in that example, they'll do 100 million of the 100 million on that seller financing. The downside to that is there's no liquidity at close. And so you're going to sell your company, you'll get nothing up front and everything's on the come. The benefit of that is you don't have a third party lender, right? And so there's pros and cons and different considerations as you think about ultimately what are your objectives, both near and long term from liquidity and wealth creation. And then also how do you think about debt as part of your capital structure? But maybe I'll head it over to Caitlin. You know, you're kind of the expert in this space, right? And to be curious your thoughts there as well.
You nailed it. I think there's those three options. Obviously, as the bank, I can talk through how we think about leveraging on ESOPs. So very similar to the seller, we're looking at the 5 to 10-year cash flows of the future and the savings that are going to be had from the tax structure, as we think about future cash flows and what the upfront liquidity could be for an ESOP transaction. What we do in that process, and for all of you that do this for your own business, we do a lot of the same things that we would do if we were lending to a business, as far as understanding the business, the credit, the people who are involved. All of those are exactly the same factors. Nothing changes there. What I would say is we look at what's the liquidity needed for this business? What do you need for your working capital, within the business as far as financing? What do you need as far as maybe growth? Because we still want to make sure that you have access to capital for growth. And then where is the benchmark above that? And that's that plug for the transaction, right? And so where do we have comfort as far as lending above that threshold? And we could spend a whole lot of time on how that formula works. But above that threshold, and let's say the business is putting off $5 million in cash flow a year. Let's just call it that, and say, we determine that we were comfortable lending 2 times that cash flow on a transaction. We want to make sure that, and you do too, you feel like within that $10 million of lending, you have enough set aside for the working capital of the business, you have enough set aside for any growth initiatives or, new equipment, et cetera, all the things you have to do as far as maintenance for the business. And then everything outside of that is capital that could be lent for the transaction. And so that's kind of a high level of how we think about the math. And it obviously determined, by industry, by company, and from there. But we say, and Dylan, I wish there was data on this. We say, at least as far as what we see, probably about a third of our transactions are 1042 driven. And so especially in states, as Deb alluded, where a seller is deferring capital gains, you really need to have liquidity up front. And so a lot of those sellers to defer that cash, because if you're selling your business, only the liquidity from the sale, from whatever the bank is providing, and the cash on hand from the balance sheet count for that deferral. And so in states where there's higher tax rates, we often see that ratio is higher. So maybe in California, where I am, closer to 60% of transactions have a 1042 component. But that'll drive some of the financing needs as well, because if you're trying to capture that, you're not going to do a seller finance transaction because there's no real cash up front. And so sometimes there's a consideration there from the bank perspective as well to help drive that funds higher and then repay debt quicker in the first few years and then focus on some of the growth capital and the rest of that later on. So it's always an equation. Like I said, we see a lot of transactions. What I probably should emphasize too, and because we see companies pre-transaction, during the transaction, and then 5, 10, 20, 30, we have a lender that was one of the first ESOPs in the country. So now, since the 70s, I'm not doing great math, but 50 plus years into their ESOP, we see a lot of the different issues that come at hand. I will say the most successful ESOPs who go through a transaction, they're not going through the transaction for the tax. If that's the reason that you're doing an ESOP, it's not going to work. Either you're not going to get to the ESOP or you're not going to have a successful ESOP. And so that's a huge filter for us as we think about the lending and the transaction itself is this set up to succeed? Is this a sustainable company, a sustainable ESOP transaction? Is this where we want to put capital to making sure, that there's a plan here in place? And so I just want to highlight that. We hear it sometimes. It's like, it's just for the tax. It's like, oh, this is not going to work for you. So back to that filter of what makes a good ESOP, that is something I would highlight.
Yeah, all great points. Deb, was there anything else you wanted to add on that?
No, I'm financing. I'll defer to Caitlin and Dylan on that.
All right, so then maybe let's talk a little bit about tax and the tax implication of things. We've mentioned it a few times here, but maybe we can dive deeper a little bit as to, what are the tax implications and what are some of the things to think about on the IRS standpoint of things. Deb, did you want to talk about that piece or?
Sure, and I think we've covered a fair number of the tax points already, so if you're an S corporation, whatever portion you sell to the ESOP, that portion of your corporate net income will not be taxed. So if you sell 30%, the ESOP will be allocated 30% of the corporate taxable net income, and that 30% will not be taxed. If you sell 100%, then 100%, as Dylan mentioned, will not be taxed. And that can generate cash flow savings and that the company then can use for other purposes, right? Because they're not necessarily having to make tax distributions out to the shareholders anymore if you're 100%. On that note, if you are a partially owned S corporation ESOP and you have to make tax distributions out to the other shareholders, the ESOP has to receive its share as well. So if you have an S corporation ESOP that owns 30% of the company, that ESOP is going to have to receive a cash distribution, just like the other shareholders will need to receive in order to pay their taxes. If as the loan is paid, as contributions are made to the ESOP, those contributions are obviously tax deductible, just like they would be for a company that has a 401k or a profit sharing plan. From the employee side of things, when they take a distribution of their account at termination, retirement, that distribution will be taxable, just like it would be from a 401k or a profit sharing plan, but they would have the ability to roll over that distribution to an IRA and defer the taxes down the road. We've talked about the 1042 rollover treatment for the selling shareholder if you're a C corporation and you're selling at least 30% of the business. So that's a tax advantage that you might, would be of consideration. So there are all kinds of little tax nuances here, both from the company side, the selling shareholder side, and the employee side, just like you might expect with any kind of qualified plan, situation. But Dylan, Caitlin, you want to add to that?
Yeah, maybe just on the 1042 side. So ESOPs are, again, super tax efficient vehicles. They can be an incredibly powerful tool on the corporate side, but on the shareholder side, it is one of the few structures and really one of the only structures that allows for a deferral of that gain that you would receive from selling your company. And as you think about that, a lot of folks here might be familiar with something called a 1031 real estate exchange, which is when you sell real estate, you can take those proceeds, invest in other real estate to defer that gain. It's something similar. It's a little more complex. It's a little more highly regulated 1042 because of the quantum of dollars we can be talking about and the structure that's being pursued. But it's ultimately an incentive that was put in place through Congress to encourage folks to pursue ESOP transactions. And the most powerful part of this, it's not just the deferral of the gain as part of selling your company, but it's called qualified replacement property or QRP, if you decide to do some research. But if that qualified replacement property in a 1042 exchange is held until death, what ends up happening is the recipient of that property, their basis gets stepped up. And so what does that mean? Well, that means you deferred the capital gain forever, indefinitely. Yeah. So you can sell your company, roll over your proceeds into a different asset, hold that asset until death. And then ultimately your next of kin, they've completely avoided those taxes, which can be in certain situations incredibly powerful. So as Caitlin mentioned, this is something in New York, in California. I'm a Minnesota native. Other states that have these particularly high state income taxes, state capital gain taxes, is something that 1042 can be super interesting in. Furthermore, what we also frequently see 1042, and given the nature of holding something until death, is for older shareholders or folks who are thinking more about a comprehensive estate plan or may have capital outside of the business that is going to fund their kind of day-to-day lifestyle needs. And so this is something that I'm sure you've picked up from this conversation, a lot of ESOPs are facts and circumstances based. But there are certain shareholders in certain situations where this 1042, and we're saving, tens of millions of dollars in taxes by pursuing that strategy. And it's something that, that kind of qualified replacement property is an asset class that the selling shareholders may have been putting some of these proceeds into anyway as part of their overall estate plan. And so from an overall management perspective or estate planning perspective, it's just super efficient. And so, the huge portion of the ESOP community, their primary focus is on 1042. And I would say there's for a lot of folks that pursue ESOP transactions, 1042 is a large driving factor that, the power of which should not be underestimated.
Excellent. Caitlin, did you have any other thoughts on that piece of things?
Maybe for the audience, when I just as a piece of appreciation, when I first learned about ESOPs, I literally said to someone, why on earth is it so complicated? Like, why do we just, it's so complicated, and the taxes and things change and structures. And I'm a very visual learner. And so I'll just say for the audience, there's some really great materials out there. There's some great education out there that shows some of this more visually, because I know some people hear about 1042, and I've heard it from many business owners of like, oh my gosh, this sounds too complicated for me. I can't, oh gosh, and they panic. And it's like, if you have the right people, you have the right advisors, you have folks who know those nuances that are going to guide you through these tax situations, that's all you really have to worry about. If you really want to understand it before you get those advisors engaged, I would say go to the ESOP Association website, go to NCEO. There's great free materials on education and how it would work for you, and you can engage with that too. So, and of course, our audience or our panel here, all of us do a lot of education and have some materials in visual ESOP 101 that kind of answer a lot of these questions too. But Dylan and Deb, you guys are going to answer the tax questions way better than I ever would. And so I wouldn't add to the nuances you just laid out. I would say there's just so many ways to skin the cat, and we see so many different things that, don't get overwhelmed or scared off by it if you come across it like I did at first. It takes a minute, but good advisors get you through it.
Yeah, it can sound overwhelming. And, the ESOP Association, there are local chapters. So the Minnesota Dakota chapter often will have seminars, conferences and of their own where they have sessions on many of these topics, including, just whether an ESOP is right for you. So they go through kind of the basics and some of these things. And to your point, Caitlin, there's some wonderful resources on the ESOP Association and NCEO, which is the National Center for Employee Ownership. They have great resources as well that give you a good overview of many of the topics that we've talked about. And it is because it can become or sound overwhelming. Yeah. So use your local resources and your advisors. Yeah.
Absolutely.
That's such a great reminder. So thank you. Okay, Karen, we are coming to the end of the hour, so I don't know if we want to start taking questions. We certainly can keep talking if there are no questions, but want to make sure we have the opportunity to answer any questions the audience has.
Sure. Actually, I had a couple questions first, and then others are certainly welcome to come off mute. My first question, I think I know the answer to this, but I just want to be explicit. So in an ESOP, does each employee have exactly the same share? So the vice president has the same amount of shares as the line employee or whatever? Or can you have some people have more?
Yeah, it's going to be typically the shares are going to be allocated based on compensation, just like you would have, with a profit sharing contribution. So everyone will receive perhaps the same percentage of compensation, but obviously the person that is, the executive with the higher compensation level is going to receive more shares than the line worker, that is lower paid. So it's generally allocated as a percentage of compensation, but people are going to have different number of shares in their accounts.
Sure. Okay. Thank you for that. My second question is, can an ESOP end? There was a comment made early in the presentation that kind of made me think that it can, but what are the implications for that?
Yeah, maybe I'll take that one. So we're currently engaged right now on a great company out of Idaho. They're a farming operation. They've been ESOP owned for about 25 years now. And it's been incredibly successful. They've created a ton of wealth for their employees. And now they're faced with an interesting choice as the agricultural space has continued to consolidate, and very large investments are required to become these like industrial type farms. They're looking at their employees as their shareholders and saying, well, I have some employees who are 60 and a few years away from retirement, some who are 20. And those who are 20, maybe they're really willing to take the risk with the company and for us to make all these capital investments. But the folks who are 60, that's kind of tough. And from the CEO's perspective, he really doesn't feel comfortable gambling with everyone's retirement on whether that's going to work out. And so he's actually in that company and the board has chosen to review their strategic alternatives, and ultimately are exploring a potential sale. And so what that would result in is a strategic party or a financial sponsor coming in and buying out the ESOP. And it sounds, some people think that's a negative, connotation, but for them, it's created a ton of wealth and frankly, a level of wealth, in these communities that honestly, a lot of these folks couldn't imagine. You have line workers making $10 an hour who have $300,000 retirement accounts. And it's an incredible outcome, and it's going to position the company for stronger competitive advantages in the future, because then they're going to feel a little more unchained when it comes to making these really large investments. And so ESOPs are wonderful. I would love for every ESOP we implement to, be around in 30 or 40 years as an ESOP. That's just not kind of reality. And ESOPs, just like any other capital structure, where maybe it was when your parents owned the company, it looked a little bit different than when you owned the company versus, hey, you brought in a partner. In ESOPs, exactly the same. Things change and capital structures change as well. And so there's nothing stopping you from exiting an ESOP if ultimately you decide that's the opportunity. We've also had situations where management has actually bought back companies from an ESOP, and that's a little more rare because the amount of capital kind of required after an ESOP is successful for a while, but that can be done as well. It's really just a tool and a capital structure like any other one. Now there's some regulatory considerations and other factors that change your company following the transaction, but in many ways it's still the same company with still the same options.
I have a follow-up to that then. So
sorry, Karen, really quickly, I just wanted to add before we move too far off of the topic, just for the broader audience, there's roughly about 7,000 ESOPs in the United States, and that number doesn't change. And to Dylan's point, it doesn't change even though there's X number of new ESOPs, because capital structures change and ESOPs terminate or sell or fail in some cases, just as companies do. And so there are lots of situations that drive that factor to stay about the same. And so, it's something you don't hear a lot, but as Dylan highlighted, things change for companies, especially if you're a partial ESOP and capital changes. We talked a little bit about this, Karen, on the last session, but often we're always talking to companies who are doing very well and they're thinking about their transaction because they're doing very well. And that's what these panels kind of focus the audience on. But sometimes, and as of late, especially, we're hearing more and more from folks who are like, hey, my company's just limping along, I'm struggling, or, there's things that I'm facing personally and I just have to, exit this business, whatever those situations are. So sometimes things aren't going really well. And that's another reason to have really good advisors to kind of help you through that process and access the free advice out there. That happens for ESOPs too, right? They get into situations, and we see it a lot. And this is, I know, for your topic, where they over levered their ESOP. And so then it's, how do we get through and make sure we can still operate our business with kind of the leverage that we took on? And so that's, a cautionary tale out there. We see it quite often, and something that we all good advisors will help you work through, but just putting that on your radar too.
It's super important. A follow-up on the sale question. So I have my company's an ESOP, it's 100% owned. and, you know, somebody buys the company, you know, the 100% for $50 million, whatever. So do my employees have tax liability, or it's just the same thing as if they left the company, they would have their distribution as you described, and then they could roll it over or whatever?
Yeah, generally they're going to receive, they're going to get, their shares will be converted to cash typically in
Okay.
that
Mhm.
scenario. And they'll get a distribution from the ESOP, which then can be rolled over just like any other distribution from the qualified plan. I would say that, you know, I've worked through several ESOP companies that have sold. It's a process. Folks need to understand that they may not get all of their money right away, all up front. There's usually some time period where we have to, you know, get some approvals from the IRS. We have to work through the winding up of the ESOP and possibly the company. And so it can take a few years to get absolutely every dime that you're entitled to. But the bottom line is that folks are going to receive cash for their shares, and then that cash distribution can be rolled over to an IRA or to another company's plan. Yep.
Mm.
Thank you.
And Karen, as part of that, we always strongly encourage in educational sessions, and this is years down the road for anyone on this call, but a big part of it, you think about the ESOP, is it is a retirement benefit. And so if someone, let's say in that example, they convert their proceeds into cash, and they're going to take that out, there's actually going to be penalties associated with that have to be managed. And so what we most frequently encourage is there's actually a great set of resources for wealth managers who work with kind of broad-based employees and who will do educational sessions about, hey, you are receiving this windfall. We would strongly encourage you to roll this over into another qualified account to continue to plan for your retirement. Because again, some folks out of nowhere, they have $300,000 of cash, and there's some strong impulses. We sold the company out of St. Cloud, Minnesota. And for those who aren't familiar with Minnesota, it's about 2 miles north of the city. You kind of get you're getting a pretty rural part. But the transaction was incredibly successful, and it made something like 100 millionaires out of the company. And which is a great outcome. And we told everyone, hey, you should really roll this. And we heard from a local dealership actually after the cash was dispersed, that was the busiest Ford dealership in the country that weekend. A lot of trucks were bought, which is a fun story, right? But it is kind of a factor where you have to manage it.
Yeah, and fairly expensive trucks by the time they pay the penalty on the money.
That's
very
exactly right.
expensive trucks.
Right. Yeah. Yeah, it's just like any other distribution. You're going to have penalties if you don't roll it over, unless you're, you know, of a certain age. Yeah. Right.
Yeah.
So I want to just say something to, I think, summarize, and then I'm going to stop the recording because there may be people who might have questions that they don't want recorded. So I want to thank you all so much for this amazing information. I learned an enormous amount, and I appreciate that. And because of all the details, maybe I might suggest to people who are considering this that the first thing that you do is think about what are your goals as the owner, as the seller, right? Why do you want out? When do you want out? And how do you want out in terms of how much control or involvement do you want in the future? The second is the number and the stability of your employees. If you have 10 folks and they're, you know, nobody has an average tenure of more than about 18 months, this probably isn't for you. But if it's long, you know, if you have more employees and they're longer serving, then that's a great thing. And then what your company's income tax liability is. If it's, you know, significant, Dylan gave the example of the company with such huge depreciation that it really wasn't much of an issue, and what you're looking for legacy. And if all of those answers kind of lead you toward, yeah, maybe this is, you know, for me and for my company, then it seems to me reaching out to an advisor is probably the next step, right? To go through all of the nitty gritties. Does that kind of make sense?
Makes sense.
Okay, well, I want to thank you. So I'm going to just go ahead and stop the recording now.